Margin investment is the practice of borrowing money from a brokerage company to invest. Traders can use it to increase their purchasing power and then repay the borrowed money at a later date of their choice. But this approach will bring huge risks, and huge losses will accumulate quickly. This means that inexperienced investors should proceed with caution. When you are trading on margin, you are borrowing money to buy more securities such as stocks, bonds, or exchange-traded funds, betting that their prices will rise. Margin loans come from your brokerage company and are similar to other credit lines. This means that you use the securities in your account as collateral, and if you cannot meet the loan terms, the brokerage company can sell the margin investment or borrowing money from a broker to buy securities. All carry huge risks and rewards. When the price of stocks and other securities rise, buying on margin can amplify the gains, but when the securities fall, it can also amplify losses. Federal agencies and regulatory agencies have established rules that specify how much money you can borrow and how much balance you must maintain in your margin account. Margin loans charge interest, which means that any profit still comes with costs. Beware of margin calls. If you buy on margin and the price of the security subsequently drops too low, you may be warned by a margin call or broker that you must deposit additional cash or margin securities, or you must sell existing securities to meet the required minimum rights and interests. If you cannot answer the phone, you can sell the securities in your account. However, during periods of severe volatility, the brokerage company may sell your securities to meet the margin call requirements. Buying securities is easier than ever. In times of financial market turmoil, it may be easy to get into trouble. But sometimes, when a buying opportunity arises, investors may not have enough cash. How to buy on margin to trade on margin? You must first open an account with a broker. Then, to qualify for a margin loan, you must apply and get approval from the company. The app usually asks you to provide employment details and financial information, such as your annual income. After approval, you can withdraw the margin loan at any time without submitting other applications. Although brokerage companies may set strict requirements, federal agencies and regulators have established margin account rules. Margin trading allows us to borrow funds from carry trading brokers, thus being able to use our existing equity to control larger positions. This can generate greater returns, but because of the size of the position we can control, it can also make up for greater losses. Managing risk is our job. Even if it is possible to control such a large position, we must abide by strict rules to protect our stock from adverse market fluctuations. Margin trading can be a good tool for establishing an account, but if used too aggressively, it can become the trader's worst enemy. The pros and cons of margin purchase. Margin investment can bring you huge benefits, but this strategy has major risks. Investors say there are other benefits. As long as you can maintain sufficient equity to meet the maintenance margin requirements, there is no set timetable for refunding margin. Also, interest rates on margin loans are often cheaper than other forms of loans such as credit cards. Margin loans can also be used for purposes other than investment. Due to lower interest rates, some investors use margin loans to help major consumers buy. Flexible margin trading not only brings you a larger position advantage than usual, but also allows you to flexibly build an investment portfolio. Suppose you have a small account. For this reason, you can only hold one position at a time. With the introduction of margin, you will be able to use your rights to open multiple transactions at the same time, so that you have the opportunity to pass multiple transactions. Everyday tools to diversify your transactions. Exponential account growth. Before there is a margin, it is difficult for small retail traders to quickly increase their accounts because they can only accept positions as large as their account balances. For small traders, managing the position and day trading tools becomes very difficult, if not impossible. Margin trading allows you to enter multiple markets at the same time of the day to profit from more transactions and exponentially expand your account to a more manageable scale. The disadvantage is cons. Even if there are potentially huge gains, margin investment may also bring significant losses. One of the disadvantages of margin investment is that loan interest also incurs additional costs. The interest rate will depend on the amount you borrowed. FINRA believes that many companies will try to notify you of margin calls, but this is not required. You also have no right to extend the time to meet the margin call requirements, and in the case of severe market volatility, the broker can immediately take measures to sell the securities in your account. Moreover, when a broker sells your securities to meet maintenance margin requirements, you do not have to choose which securities to sell. Also, the brokerage company may increase its maintenance margin requirements. At first glance, using leverage trading and borrowing funds from your broker for larger transactions sounds good. But you need to know that margin trading may have a great adverse effect. If you are subject to disciplinary action, it is possible but manageable. Conclusion: in the stock market, margin trading refers to the process by which individual investors buy stocks that are beyond their capacity. Margin trading involves buying and selling securities during a trading day. With time, various brokers have relaxed their time restrictions. This process requires investors to speculate or guess the stock trend in a specific period of time. Margin trading is an easy way to make money quickly. With the advent of electronic stock exchanges, what was once a field of expertise is now accessible even to small traders. The process is very simple. Margin accounts provide you with the resources to buy any amount of stocks, and these amounts are beyond your capacity at any time. To this end, the broker will borrow money to buy stocks and use them as collateral. To use a margin account to trade, you first need to send a request to the broker to open a margin account. This requires you to pay a certain amount of cash to the broker first, which is called the minimum deposit. If the trader loses the bet and fails to get the money back, this will help the broker to get some money back by rounding.